It's Wednesday, October 15th, and I'm getting ready to head out for a business conference to catch a flight. But I want to get this video out to you to give you some perspective and a way to think about this recent volatility and substantial pullback from all-time market highs in the equity markets. So to give you some perspective, what I have here is a history of declines, and the data we're looking at goes back to right after World War II, 1946, through 2013. Notice in the first row what I have here, a 10% decline or more happened 53 out of 68 years. That means there's almost 100% likelihood that we're going to have sometime during the year an inter-year decline of 10% or more. And what do we mean by inter-year decline? Meaning sometime between January and December, through that year you may have an inter-year decline. So even though the year might end up positive, you may have had a substantial pullback sometime during the course of the year. So think of it as I should be expecting to have at least a 10% or more pullback once per year. The second row there is a 15% decline or more happened 21 times out of 68. And then a 20% decline or more happened 12 out of 68 times. So prepare yourself for a pullback of 20% or more once every 5.5 years. And think of it at least having a 10% pullback once every year. Just expect it. Also, to bring some perspective, the average of those pullbacks during that 68-year time period was about a negative 14% decline. And that's basically what we're experiencing right now in 2014. All that means is this is average. You should be expecting it. The second thing to point out is the declines that were more than 20%, they were an average of negative 30%. That's what we experienced in 2008. So when things got really bad in 2008, about once every 5.5 to 6 years, you can expect them to go down maybe negative 30. So what do we do with all this? You might be thinking, David, with that kind of volatility in intra-year declines expected of 10% or more, why would I want to invest in the equity markets and stay invested like we're having right now? Again, we go back to perspective. January of 1946, give me a wild guess of where you think the S&P 500 was at. 18. I didn't drop a zero. That's where the Standard & Poor's, back then it was called the S&P 50, but that's the closest representation we had to the S&P 500 was at 18. Here, even after this recent pullback in October 2014, it's at 1855, meaning it's 100 times higher than it was back in 1946, and that does not include dividends. So that's a tremendous increase of 100-fold during that time period when, on average, each year we had an intra-year decline of negative 14%. Also, in addition to that, out of those 69 years, 49 out of those 68 had positive returns at the end of the year, or roughly 72% of the time. This might sound crazy, but 2014 could still end up positive even with this recent volatility. So what to take home with you? Volatility is defeated by discipline and time. Your investment plan was created to give you the downside risk that you can handle and to give you long-term returns that equities provide. Stay with your plan. If your objectives haven't changed, then the plan and the investment strategy hasn't changed either. Remain disciplined, remain focused, and as always, we wish you the best of success.